Hello, everyone, and welcome to another episode of Malone Bailey's official podcast, Everybody Counts. Thanks for tuning in. I'm Matt Setzikorn from the marketing department at Malone Bailey and administrative department as well. Hopefully, this isn't your first time tuning in, but if it is, welcome. Our podcast, Everybody Counts, features various perspectives on a variety of topics, from the latest SEC and FASB updates to discussions on recruiting, retention, and so much more. Everybody Counts explores trends and hot topics that affect us and those in our business. Tune in to hear from partners and staff alike. The conversation is versatile and everybody's input counts. And today's conversation will be two different FASB accounting standard updates, otherwise known as ASUs. I'm delighted to be joined today by Hazel, one of our audit managers at Malone Bailey, who will share her thoughts on these accounting standard updates. So welcome, Hazel.
Thank you, Matt.
So Hazel, before we move on to today's topic, can you share some information with us on your background, what you do at Malone Bailey, etc.?
Sure. Hello, everyone. My name is Hazel. I am one of the audit managers here. I graduated from Boston College for my master's degree, and I have joined Malone Bailey since then. It has been my 10th year here, and I mostly work on public companies from industries such as REITs, retail, manufacturing, and also crypto assets.
Okay, awesome. So 10 years, that's a long time, huh?
Yeah, time flies.
Yeah. So without further ado, let's just dive right into today's topic. So the first ASU I'd like to discuss is business combinations, joint venture formations, recognition, and initial measurement. So for those who may not know, this ASU applies to the formation of entities that meet the definition of a joint venture or a corporate joint venture as defined in the FASB Accounting Standards Codification Master Glossary. While joint ventures are defined in the Master Glossary, there has been no specific guidance in the codification that applies to the formation accounting by a joint venture in its separate financial statements. Now, the amendments in the ASU require that a joint venture apply a new basis of accounting upon formation. Now, as a result, a newly formed joint venture upon formation would initially measure its assets and liabilities at fair value, with some exceptions to fair value measurement that are consistent with the business combinations guidance. So Hazel, for starters, why is FASB issuing this ASU?
So before this ASU, there was no authoritative guidance in US GAAP that addressed how a joint venture should recognize contribution received. As a result, there has been diversity in practice, with some joint ventures accounting for contribution received at carryover basis and others at fair value. This new guidance is intended to reduce diversity in practice and provide users of joint venture financial statements with more decision-useful information. It may also reduce the amount of basis differences that an investor in a joint venture needs to track.
Okay, that's interesting. Yeah. So what would you say are the main provisions of the ASU?
Okay, so the formation of a joint venture results in the creation of a new reporting entity, and none of the assets or businesses contributed survive as an independent entity or as the historical operations of the entity. Accordingly, unlike in a business combination, the formation of a joint venture does not result in the identification of an accounting acquirer or a determination that one party gained control over another party. As a result, the guidance requires a newly formed joint venture to apply a new basis of accounting to all of its contributed net assets, which result in the joint venture initially measuring its contributed net assets on the ASC 805-20 business combination. While many aspects of the new guidance are comparable to an acquisition accounting, the new guidance does not refer to the joint venture or any of the ventures as the acquirer or the contributed net assets as the acquiree. The FASB did not want to imply that this new guidance will affect the application of acquisition accounting, particularly when a newly formed entity is utilized.
Okay, gotcha. So when would you say the changes go into effect?
The new guidance is effective for all newly formed joint venture entities with a formation date on or after January 1st, 2025. And the new guidance should be applied prospectively with early adoption permitted. However, if you have a joint venture formed prior to the adoption date, and you may elect to also apply the new guidance retrospectively back to their original formation date.
Okay, so they still have a little bit of time there. So who is affected by this ASU?
So the amendments in this update affect accounting for contributions received upon formation by entities that meet the definition of a joint venture or a corporate joint venture, as defined in the master glossy of the codification. As mentioned before, any existing joint ventures also have the option to apply the guidance retrospectively.
Gotcha. Okay. So, what are some questions to be mindful of as it pertains to this ASU?
I would say that we need to be mindful about the scope limitations of this ASU. So this new guidance does not apply to formations of joint ventures that are determined to be not-for-profit entities or entities that may be proportionally consolidated under certain specialized industry guidance. And additionally, collaboration agreements are also excluded from the scope of the new guidance unless there is part of the collaboration that is conducted in a separate legal entity that meets the definition of a joint venture. And in that case, the joint venture should apply the new guidance in its standalone financial statements.
Interesting. Okay. So for our second ASU, we have segment reporting, which is topic 280, which is improvements to reportable segment disclosures. Now, the amendments apply to all public entities that are required to report segment formation in accordance with topic 280, segment reporting. The amendments in this ASU is intended to approve reportable segment disclosure requirements, primarily through enhanced disclosures about significant segment expenses. So Hazel, could you just briefly explain why FASB is issuing this ASU?
Sure. The current segments guidance was originally issued in 1997 with very few amendments since then. However, users of financial statement have on multiple occasions asked for more detailed and disaggregated segment information. So this ASU addresses much of the concern that more segment information is needed, including allowing the disclosure of multiple measures of segment profit or loss, requiring the disclosure of significant segment expenses, and requiring the qualitative disclosure of other segment items.
Okay, gotcha. So what would you say are the main provisions of the ASU?
I think the biggest change in this ASU is the requirement for public entity to disclose its significant segment expenses categories and amounts for each reportable segment. Our significant segment expense is any significant expense incurred by the segment, including direct expenses, shared expense, allocated corporate overhead, or interest expense that is regularly reported to the chief operating decision maker and is included in the measurement of segment profit or loss. The disclosure of significant segment expenses is in addition to the current specifically enumerated segment expenses required to be disclosed, such as depreciation and interest expense.
Okay, so when do you think the changes are going to go into effect?
These amendments in this update are effective for fiscal years beginning after December 15, 2023, and interim periods within fiscal years beginning after December 15, 2024. Early adoption is permitted, and a public entity should apply the amendments in this update retrospectively to all prior periods presented in the financial statements. And upon transition, the segment expense categories and amounts disclosed in the prior periods should be based on the significant segment expense categories identified and disclosed in the period of adoption.
Okay, cool. So who would you say is affected by this ASU?
So these amendments apply to all public companies that are required to report segment information in accordance with topic 280 segment reporting.
Gotcha. Okay. So what are some questions do you think, in your opinion, would you think to be mindful as it pertains to this ASU?
I would say the measurement of significance could be tricky. The ASU requires disclosure of significant segment expenses, but it does not define the term significant. The ASU also does not prescribe a specific quantitative threshold to assess significance either. Rather, it requires significance to be addressed and assessed using both quantitative and qualitative factors depending on the facts and circumstances. So it also states that an item of a segment information may be considered significant if its omission would change an investor's understanding of the segment results to a degree that is what cause investor to change its investment decisions. So I would say that's definitely a lot of management judgment involved here.
Okay, gotcha. Yeah. So where do you think one can find more information about the amendments we've discussed here today?
So more information could be found directly from the FASB website.
Okay, just direct from the source. That's good. You don't have to go digging for them then. Well, that's all the questions I have for you today. Thank you so much, Hazel. Thank you again for taking your time out of your day to discuss this topic with me. We're gonna switch gears now and play a little game, what we like to play here on the podcast. It's called This or That. So I'm gonna ask you a quick question, and you'll just choose whichever one you prefer. Okay? So first question is iPhone or Android?
iPhone,
All right. Second one is summer or winter?
summer.
Gotcha. And then last one is salty or sweet snacks.
I like both. If I have to choose one, I would say salty.
Okay, not a big sweets person. All right. Well, thank you again so much for the helpful information today. I'm super appreciative of you taking time out of your busy schedule to chat with me, Hazel. I had a great time talking with you. And to everyone listening, we really appreciate you listening in and invite you to check out our website, www.malonebailey.com, for more information about public company audit services, as well as some other useful resources. You can also check out, like Hazel said, the FASB website for more information on these ASUs and other ASUs as well. Thanks again for listening. And we're done. Yay!